Today, I'm going to explain the differences between surety underwriting versus traditional insurance underwriting. As we all know, when it comes to surety, the primary purpose of surety underwriting is to guarantee the performance or obligation of one party to another. In this example, we make sure that the principal, which is otherwise a contractor or a company, is performing their job as per their contract to the obligee. The principal is not performing their job as per their contract, then the surety will kind of cover the loss, and in turn the surety will reimburse, or like the surety will recover. Hi everyone, this is Prashant Parthiban. Today I'm going to explain the differences between surety underwriting and traditional insurance underwriting. As we all know, the primary purpose of surety underwriting is to guarantee the performance of one party to another. Meaning, if you have a contractor, the surety bond will make sure that the contractor completes the work on time with good quality. If not, they will kind of cover those losses to the obligee. And one thing to note here is the surety will pay the losses and they will make sure to recover that from the principal again. That is the primary difference. Whereas in traditional insurance, it's not the case. The insurance company, they provide the financial protection against unexpected losses. In this case, they don't go and recover that money from the insured. So they make sure that they kind of select the correct insured and they look at the loss exposures, etc. If there is a loss, it's a loss to the insurance company. Whereas in surety, all that they do is they take some amount of fee to represent the principal, and if there is a loss, they will go back to the principal and recoup those lost money. And as I told you, in terms of risk assessment, because of the fact the insurance company have to recoup the money when there is a loss, they pay more attention towards principal's financial strength, capacity, and their track records, or how they have done their contract jobs, etc. Whereas in terms of traditional insurance, the insurance company kind of access the potential future risk or likelihood of claims. As we all know, in terms of traditional insurance, if the risk potential is higher and if there is a loss, the insurance company also will be at loss. So they focus more about the potential future loss rather than seeing at the principal's financial strength. Whereas in surety bond, because of the fact that the surety company will recoup the money from the principal again, they will look at their financial strength. The third point is important, right? In surety, it's a three-party contract. Surety, which is nothing but the insurance company, and the principal, which is like a contractor or some third-party company. An obligee who is kind of providing work for the principal. It can be a government entity or private entity. Whereas the traditional insurance, it's only two parties, the customer and the insurer. And the fourth point is important, right? Because of the fact the surety is going to recoup the money from the principal. Sometimes they can have collateral, meaning advance payment made by the principal to the surety, so that if in case the surety cannot make the payment back to the surety will take the amount from this advance collateral amount. But in case of traditional insurance, there is nothing like collateral, because most of the time it will be a kind of loss, and then insurance companies will pay back those losses. There is no thing like a concept of insurance company going back to the principal and or the customer and getting back the money. So there is no collateral there. As one of the real-time example, right? Construction company is looking for a surety bond for a project where they are doing some kind of construction work, right? Whereas in this case, if there is a loss, the surety will pay the money and then they will go back to the principal and recoup that money. Whereas in traditional insurance, homeowner can purchase a insurance for their home. In case if there is a loss, it is the sole responsibility of the insurance company to pay that losses. So in short, like core things you need to remember is in surety underwriting, they focus more on financial strength of the principal, because here if they pay a loss, the insurance company is going to go back to the principal and recoup that money. Whereas in traditional insurance, there is no concept of recouping the money. So they focus more about their risk and future expected losses. And surety is always three party, whereas traditional insurance is two party. And because of the fact, like no, the surety is going to rely on the principal to recoup the money, there will be some collateral. In case of traditional insurance, there is not much of collateral. Very rarely there should be some collateral, but traditionally we don't have much of collateral concept here. Thank you once again for your continuous support. Have a great day.